Welcome to the 2008 Jim and Judy O'Brien Financial Markets and Economic Colloquium. This is the third year that we've conducted this event, and I think anyone who's been there in the past can attest to the fact that this has become a must-see, must-listen-to, must-attend event. Last year, anybody who was here would have been able to ascertain that we were going to have credit problems in 2007, and those indeed came to fruition. Now we're here to figure out what's going to happen in the year ahead, 2008. So what I'd like to do first, I'd like to ask today's MC, Sophia Iqbal, to come up and please begin the event. Thank you very much.
Good afternoon. I would like to welcome you all to the third annual Jim and Judy O'Brien Financial Markets and Economic Colloquium. We have a three-part program for you today. First, the Stillman School's Investment Club will be assessing the impact of the 2008 presidential election on financial markets. Second, our keynote speaker, Mr. Henry Chip Dickson, will provide a macro finance perspective, the impact of the Federal Reserve on financial markets. Third, our panel of experts will be offering a microfinance perspective on these and other issues for investing in 2008. I now introduce the president of the Investments Club, Mr. Michael Cavallero, who will coordinate the presentation of the presidential election on financial markets. Mr. Cavallero.
Welcome to the 2008 Colloquium. 2008 marks an important year in the history of our nation because it's a presidential election year. We as investors must be ready to survive any marketplace, regardless of whether a Democratic president or a Republican president is elected, and apart from our political ideology that we follow. We must not only be able to survive these marketplaces, but also to prosper. The Investments Club here at Seton Hall was formed 3 years ago and has been investing in and researching the financial markets and the Center for Securities Trading and Analysis, also known as the Trading Room. If you'd like more information on the panel speakers for our investment club today, please grab one of our resume books in the back. During the fall 2007 semester, the Investments Club has spent every Friday dissecting the S&P 500 and other investment vehicles in an attempt to predict the winners and losers for the upcoming years. As part of this research, the Investments Club has recently conducted a study on how the financial markets have performed under various presidents since the 1950s. Further, the Investments Club has gathered the information on the top 6 presidential candidates running for office this year, and we have identified which investment areas are more likely to prosper under either of the candidates. Our main goal was to answer 2 questions with a nonpartisan view, putting our political ideologies aside and looking at these questions from a purely financial perspective. The first question we wanted to answer was whether certain types of investments perform better under a Democratic president or a Republican president, and if we could identify what these investments are. The second question we wanted to answer was which type of investment vehicle would likely perform best under any of the current candidates who may be elected. We canvassed many scholarly journals, articles, and conducted our own hard data research using the Bloomberg terminal and Reuters stations in the trading room. I am now going to turn over the discussion to Matt Summelrock to discuss the historical market data based on performance of past Democratic presidents. Matt?
Politics move markets. Political parties, directly and indirectly, have a huge impact on global markets from historical data based on market performance during past presidential terms. As the Democratic moderator, it is my role to give you a historic overview of market performance during Democratic presidential terms in office dating back to John F. Kennedy. In order to make a significant and appropriate comparison, we have taken market data based on the Dow Jones Industrial Average from Bloomberg and will compare the rate of growth during each Democratic presidential term to a level of economic success while in office using data from the working paper, Monetary Policy Regimes and Economic Performance, the Historical Record by Michael Bordeaux and Anna Schwartz from the National Bureau of Economic Research. The first Democratic president we'll be examining today is John F. Kennedy. At the immediate date of Kennedy's election, the market, specifically the Dow Jones Industrial Average, was at a market value of 600. The market, with some volatility, ended with an increase of 274 points at his assassination. During his career in office, the market ended with 874 points, showing an overall 46% growth rate during Kennedy's years. Looking at his success in office, 46% over 3 years in office can be qualified as a significant rate of return. Examining policies under his presidency and specific regimes, it can be noted that the overall economic regime in place at the time was that of Bretton Woods. Out of the Bretton Woods regime, the standard that developed was that of gold. The United States and Kennedy, pegging the price of gold, watched as the rest of the world, in turn, pegged their currencies to the dollar. From this factor, the U.S. was able to take significant control of the global economy due to the fact that the dollar became the global reserve currency. The U.S. economic rise to power can explain the sudden rise in the markets as well as the steady growth. While the Cold War and political issues dealing with Russia and Cuba can account for the fall, on top of issues dealing with liquidity and consumer confidence. Despite the rapid economic growth at the time, the Fed decided to take a more restrictive monetary stance, which means, for example, the selling of bonds in order to reduce the money supply. They did so to avoid too much growth at one time and target a goal of full employment. During the transition of Johnson, there was no significant rise or fall of the market, and the average, when he was elected, remained right around 874 points. Through the course of his presidency, the market was extremely volatile, reaching a peak in February 1966 with a high of 995 points. From that point, there was a major fall, mostly due to the outbreak of the Vietnam War, along with the fact that the requirement for gold reserves was drastically reduced, with the market reaching a low of 744 points on August 1966. With much volatility, the market rose again to the end of his presidency, where his market ended at 946 points. From this, we see an overall 8% growth rate during Johnson's term as president. Due to more political issues impacting the economy, based on the minimal increase in the Dow, growth would not be at levels like during Kennedy's presidency. Although the U.S. remained a global player economically, at the end of Johnson's presidency and beginning of Nixon's, the United States broke the implicit rule of the dollar standard they had set by not maintaining the price stability. Due to this instability, the Bretton Woods regime would cease to exist, as the global issue of using the dollar was the fear of the increasing inflation. Jimmy Carter was elected with an opening market value of 961 points. The market soon thereafter peaked at the highest point of his presidency, being 1,005. After the peak, there was a steady decline to a low of 742 on February 2nd, 1978. There was much volatility after that point until the end of his presidency at 945. That shows a growth rate of negative 1.6%. Why was Carter's presidency marked with a negative return? During Carter's term in office, much of the economic issues and occurrences were that of the development of the floating exchange rate that occurred during Ford's presidency, or a dirty float, that created much volatility and required much intervention. Also, the volatility and falls in the market could be traced back to the oil price shocks that were reoccurring and the need for the expansionary monetary policy, ultimately leading to a high rate of inflation at the end of his presidency and the lead issue into the 1980s. President Clinton was elected when the Dow was at a market value of 3,246. During both terms of Clinton's presidency, the Dow saw tremendous growth, experiencing only one significant fall over about a 2-month period in 1998. The market rose again until peaking at its highest point of his presidency, 11,723 points. From that point on January 14th, 2000, the market dropped slightly and evened out until the end of his presidency, where the market closed at 10,950. Clinton's growth percentage of the Dow from his start to his finish was 237%. Imagine having a 237% rate of return over 8 years. Let's just say we could all retire at an early age if that were the case. Clinton's presidency is marked by an economic boom cycle from global expansion, as well as the tech and the dot-com boom of the late 90s. During his presidency, the Fed also shifted its goals to target low inflation as it adjusted the target rate. On average, the Democratic presidents, as seen from proof using the Dow, have outperformed the Republicans. The overall growth average for the 4 Democratic presidential leaders is 72%, which is remarkable. If a Democratic president is elected in 2008, will this average hold up? I leave that to the rest of the investment club to assess. Thank you.
Thomas Klemek will now discuss the historical market data based on performance of past Republican presidents.
My speech will contain information from Monetary Policy Regimes and Economic Performance, the Historical Record, by Michael Bordeaux and Anna Schwartz, the National Bureau for Economic Research. There's also research performed by myself and my fellow colleague through the system called Bloomberg. With the information gathered and stated, I may only say that it is now up to you, the audience, to interpret the knowledge and put it to good use. For the past 50 years, there was a majority of Republican presidents that were ahead of this country. I start with President Eisenhower at a point where the economy was ever evolving. Our economy went from gold backing to our dollar to faith. In the 1950s, we as Americans had faith and started buying goods and growing as consumers. During Eisenhower's era, the market began to grow, starting with the Dow being at 273 points, climbing to 294, which was the peak in the end of the year of 1952, and then experiencing much volatility for the rest of 1953. The market rose at a steady pace in the years to come due to increased consumption by consumers and new emerging markets. Towards March 1958, the market reached an all-time high of 685 points before leveling out to its career-ending amount of 600. An overall 237-point increase from being elected to leaving office, and a market growth rate of 120%, which is an enormous amount of growth. Moving into the 1960s and 1970s, the United States began to peg the price of gold, and the rest of the world pegged their currencies to the dollar, which gave the economy good control of the value of the dollar and the world prices of gold. However, in these years, the president, who was Dickson, suffered in the market with high volatility and only a 1.5% overall growth from 1969 to 1974. The market did reach a high of 1,052 points on January 13, 1973, but the market had an all-time low towards the end of that same year. During this volatile period, there was much arguing and debating over dollar standards, gold prices, and faith in our currency. With high amounts of dollars being converted to gold, Dickson resolved this by closing the gold window, ending convertibility on August 15, 1971. This may be one of many reasons for this poor performance. This volatility continued to President Ford's term, doing little to his success, in his time making the Dow difficult to evaluate. He had an overall growth of 0% from 1974 to 1976, with no change from 961 points entering his term and leaving with 961 points, which is an odd performance for a 3-year period. This volatility and poor overall performance may still have been a continuation of foreign exchange fluctuations and monetary irregularities throughout the world. It must be understood that in these times, the American public was recovering from war and global economic irregularities. After some rough time in the Republican presidency, President Reagan came to power, entering the market with a strong Dow Jones average of 1,216 points. Reagan experienced continual steady growth to 1,821 points from 1984 to 1985. Reagan had consistent numbers until 1987, where the market rapidly grew, reaching a high of 2,722 points on August 25, 1987. Soon after, on Black Monday, that October, the market fell 769 points, but regained steadily until evening out. Even with the crash and other problems in the world during this era, Reagan came out with an overall growth of 75%, showing that the market still ended up for that same year. Continuing this strong market growth was the next president, Bush Sr. Continuing after Reagan, Bush Sr. had small ups and downs, but by 1991, the market reached 2,482 points. Continuing off a steady growth, the market reached a peak of 3,413 points that final year of Bush Sr.'s presidency. In his last month of his presidency, Bush Sr. ended the term with the market leveling and the Dow Jones average of 3,246 points and an overall growth through his career of 52%. The early 1990s were the start to ever-growing global demand of our money, products, and labor. Now coming to our present president, George W. Bush, elected in November of 2000, entering with 10,950 points, and in office to this present day, the economy is as strong as it can be with the highest gross domestic product in this nation's history, and we are the world's largest economy overall. However, evaluating his first term on the Dow Jones average may be classified as one of the most volatile presidential terms yet, reaching extremes with differences between the low and the high being at 7,000 points is a difference that should be something to talk about. With the fall of the market after September 11, 2001, it was understood an act such as that was a shock to the economy. But for the years to come after the crash, the market regained its composure. With the credit crunch, the market is in high volatility and dismay until the market can regain control of spending and putting faith back into our system. The Federal Reserve is trying to keep inflation low and the value of our currency up, even when countries change to other currencies. The market in President Bush's term is that of a global economy that relies on other nations' performances that will affect this nation itself. It must be stressed, in this modern day of age, the nation is fast-paced and ever-evolving so quickly that any market is unpredictable. The Republicans that served this nation from the 1950 to the present day had an overall 40% growth, positive market growth, which is still impressive even when they went through war and other economic stresses. There is a growing world around this audience, and the decision lies in your hands for tomorrow's leaders. Thank you.
We're going to now turn our discussion to the current presidential candidates. Discussing Barack Obama is Ian Mihawk.
Thank you very much, Mike. Barack Obama has a plan centered on tax cuts, alternative energy, and technological advancement. What most investors should notice about Mr. Obama's campaign is the way he has attacked the current tax breaks for the wealthy. His party estimates that due to these breaks, there will be over $2.3 trillion in losses before 2010. Mr. Obama plans to repeal the tax for those families over the $250,000 plateau, leading to increased funds for middle and lower class tax cuts. With added money from their tax breaks, the middle class could help to bolster the economy, possibly leading to a trend reversal in the retail and luxury goods sectors. Companies such as JCPenney and Coach could see a bounce back if the tax cuts for the lower class were to happen. Along with his aim to bolster middle class tax cuts, Mr. Obama has invested large amounts of time creating a plan for global warming. Over 10 years, Mr. Obama wants to spend $150 billion to deploy climate-friendly supplies. His plans also include a 50% decrease in energy intensity by 2030. Coupled with his plans on reducing carbon emissions by 80%, Mr. Obama's campaign calls for a massive overhaul of energy manufacturing and usage. With that said, renewable energy stocks such as First Solar Incorporated could thrive, while an increase in production costs could hurt the automotive sector and stocks like Ford and General Motors. The final point Mr. Obama looks to address during his presidency is an expansion of broadband-capable communities. With help from the reform of the United States Fund, Obama seems poised to combat this issue. Additionally, Mr. Obama is against the high fees charged by internet service providers, while favoring the growth of small market providers. With this approach to a large-scale internet audience, it might be wise to invest in technology companies such as MEMC Electronic Materials, while straying away from internet providers. In conclusion, an investor needs to look towards growth with Barack Obama as president. Investors should look for opportunities in technology and renewable energy sectors, while being cautious on the automotive industry and internet providing companies. Thank you.
Thanks, Ian. Discussing John Edwards is Ricky Rosario.
Thank you. Unfortunately, as of today, John Edwards dropped out of the Democratic Senate race. But had he continued his campaign, this would have been his policies. John Edwards had a tax reform plan that included new tax breaks to strengthen the middle class and to repeal the Bush tax breaks for households earning more than $200,000 a year. His tax reform plan also included the shutdown of special loopholes that elite Wall Street traders used to pay only 15% in taxes on their large incomes, while regular taxpayers paid double that. Edwards planned to rewrite our tax code in order to make it more simple, fair, and to help hardworking families save tax money. He wanted to expand the earned income tax credit to reward low-wage workers by tripling the EITC for single adults and cutting the marriage penalty. Edwards had plans to restore the investment income tax to 28% for Americans making more than $250,000 a year, so that wealthy investors wouldn't pay a lower rate on investments than many regular Americans pay on wages. Edwards also wanted to propose a tax reform plan that would have raised high earners' marginal rates from the current 35% to 50.2%, and actually more than 60% if state taxes were included. He was also planning to go after businesses that use offshore tax havens by working with other nations to fight tax evasion. This would have eliminated special tax breaks for corporations' offshore investments. In addition, John Edwards had a plan to make trade more safe and efficient. Companies that could have been negatively affected by a stricter trade plan are the companies that are more profitable because of direct outsourcing and global supply. Companies like Walmart and Toys R Us are examples of these types of companies. Edwards would have rejected trade deals for corporate insiders that leave regular workers out in the cold. He would have demanded environmental standards to prevent multinational companies from exploiting weak laws and avoid environmental enforcement while doing business in other countries. Edwards would have insisted that trade deals include strong, clear language on impermissible currency manipulation and make it easier for the Treasury Department to act on unfair trade practices of countries such as China. These protections on trade would have included improved food inspection, zero tolerance for unsafe toys, and requiring pharmaceutical companies to trace drug shipments electronically to assure that they remain safe. So you ask, what would have been the effects of Edwards' plans on our financial markets? Well, John Edwards' trade plans would have probably made it worthwhile to go short on global stocks because investors would have been highly worried about the potential impact John Edwards' trade policies might have had on world trade and the global economy. His tax reform plan, on the other hand, would have made it sensible to try and stray away from large cap stocks and look into small cap stocks. The reason for this is because John Edwards' tax plan targeted large cap companies and corporations. Thank you.
To discuss Hillary Clinton is Daniela Ortiz.
Senator Hillary Clinton plans to lower taxes, primarily for the middle class, by cutting taxes by the following: child tax credit and marriage penalty relief, by offering new tax cuts to health care, college, and retirements, by extending and expanding upon the EITC, which is the earned income tax credit given to those who earn low to middle income, as well as expand on the child care tax. That being said, her aggressive plan to jumpstart the U.S. economy is a proposal of $70 billion to stimulate the economy that will aid families who have been in turn affected by the subprime mortgage crisis. Specifically, once again, the plan is intended for homeowners who have been harmed by the housing foreclosure crisis. And on a general overview, this would be accomplished by providing immediate help and relief to families who are facing elevated bills in energies, by supporting workers who have in turn lost their jobs, and a push towards investments in alternative energies by creating relatively 5 million new job opportunities in that sector, with the intent to decrease our reliance on foreign oil, as well as addressing our concerns on global warming. She plans to create a national energy council within the White House to ensure implementation of the plan across the executive board. Thus, from an investor standpoint, you could expect to see expansion within the alternative energy sources. Companies that may be viewed favorable include First Solar, SunPower, Archer Daniel Midland, and Bunge. We might see inflation in prices of many important commodities such as corn, beef, milk, and other such essential staple foods if this plan is introduced. In turn, oil companies can be negatively affected. On a positive note, one could expect to see an overall growth in the green building industry sparked by the new job creation and the investments put towards that industry. On the financial side, companies tied with the housing markets would have a new progressive avenue to market. In the event of a recession in 2008, her plan would be broken down by the following. Establish a $30 billion emergency housing crisis to assist states and cities mitigate the effects of the mounting foreclosures. Take bold action to tie the foreclosure, including a 90-day moratorium on subprime foreclosures and an automatic rate freeze of the subprime mortgages for at least 5 years. Provide a $25 billion emergency assistance for families facing intensifying heating bills. A $5 billion new alternative energies investments to jumpstart the green collar growth in jobs. And finally, a $10 billion in extending and broadening the unemployment insurance for those who are facing or struggling to find work. Alongside her plan to fuel our ailing economy, Senator Clinton has unveiled a plan to ensure that all Americans have affordable, quality health insurance. So, what are the implications for investors of her policies on our financial markets? Well, many investors might be skeptical about the stocks in the pharmaceutical industries if the past is a precedent due to the decrease in stock prices in 1993 for the government fear of intervention. To conclude, healthcare insurers would receive a boost of the large amounts of Americans now being covered. Such companies that would see a jump in growth revenue include United Health Group, WellPoint, Cigna, as well as the Congressional Insurance Plans.
Now turning to the Republican candidates, we'll start with Mitt Romney, who Jay Zalowitz will be discussing.
Mitt Romney plans to make Bush's tax cuts permanent, abolish the estate tax, create a savings incentive plan, lower marginal tax rates, and create a competitive corporate tax. He's also the first candidate to sign the Norquist tax pledge, meaning that he will not raise any taxes. Sectors that will be affected by this will be that they'll have high dividends, mid-caps, consumer staples, luxury stocks, and stocks that benefit from the lowering of long-term interest rates. Specific stocks and ETFs that will stand to gain from such measures will be the Dow Jones or S&P Dividend ETF, Vanguard 500, GE, Boeing, and DuPont. On federal government spending, Romney would veto domestic non-defense discretionary appropriations that increase spending by more than inflation plus 1%. In addition to this, he would re-examine and evaluate all federal spending programs to identify waste, duplication, and inefficiencies that can be eliminated. In addition to this, he would authorize the executive branch to spend up to 25% less than Congress appropriates for a given product or agency. Companies that would suffer from decreased government spending include Halliburton and United Technologies. It should be noted that he does not say he will freeze military spending. However, companies such as Halliburton will be less protected than other stocks that benefit from more, such as Lockheed Martin. Romney's plan on health care encompasses making all health care expenses tax deductible, helping pharmaceuticals, as people would be more apt to pay for drugs ahead of time than wait to go to catastrophic care. More notably for insurance carriers, he would maintain free market insurance. This encourages states to eliminate the insurance regulations that drive up costs and providers out of the market. This would go to help insurance companies tremendously and cause growth in the insurance sector. Stocks that will easily benefit from this will be Aetna and Pfizer. Companies that may be negatively affected would be Humana, WellPoint, and United Health. Thus, in conclusion, he plans to lower the corporate tax rate with the intention to stimulate America's business environment to make it more competitive with the rest of the world, as well as to attract capital and encourage investment.
To discuss John McCain is Jason Benson.
John McCain's fiscal policy primarily centers on tax reformations to promote economic growth, as well as an increased military defense strategy. First, McCain supports the Bush administration's tax cut program, which benefits primarily upper-class Americans. However, to compensate for the hardworking middle-class citizens who are not as positively affected by the Bush tax cut program, McCain proposes to cut nearly $60 billion per year in taxes for middle-class Americans. Thus, an average middle-class family with children will save nearly $2,700 per year. Further, McCain proposes to cut corporate taxes from 30% to 25%, which will provide an increase in business activity. Other tax reforms include lowering Medicare premiums, personal and family insurance reforms, which include $2,500 tax credits for individuals, and $5,000 tax credits for families. These newly imposed changes will increase the incentive to buy insurance. Also, McCain believes insurance programs should be available nationwide and across state lines to provide maximum consumer choices. By allowing more choices for consumers, competition between insurance companies will increase. On another note, John McCain's strongest stand is in military defense strategies. He believes a strong commitment to our military is essential and necessary to ensure long-term safety and success. He will likely increase government spending by reconfiguring our Army, Navy, Air Force, Marines, and Coast Guard. He will also push for rapid and ongoing modernization in our military with advanced weapons. In order to fund these restructures, McCain plans to reform government budgeting process by funding from regular budgets instead of emergency budgets, which turn out to be very costly. Now, where to invest? I look toward conventional U.S. Treasury bonds, 5 to 30 years, but not necessarily Treasury inflation protection securities. Also, investment-grade corporate bonds and technology stocks such as Cisco, IBM, and Microsoft would prove to be strong investments. McCain's reform in healthcare and insurance sectors will cause insurance stocks such as the Humanas, the WellPoints, Aetnas, and the Prudentials to thrive. Furthermore, with McCain's emphasis on military defense strategies, I propose investing in defense contractors such as Lockheed Martin, Raytheon, General Dynamics, and Boeing. Thank you.
To discuss Mike Huckabee is Andrew Mancini.
This afternoon, I will be examining the issues of Republican presidential hopeful Mike Huckabee. As the 54th governor of Arkansas, Mr. Huckabee intends to implement a national consumption tax, or what is known as the fair tax system. This proposal could have an interesting yet dramatic effect on financial markets, specifically in sectors involving high-end luxury goods and consumer staple or necessity products. The fair tax system would enforce a national retail sales tax, or consumption tax on consumer spending. Under this new fair tax system, Americans would no longer have to pay any federal taxes, which include income tax, Social Security and Medicare tax, payroll tax, the alternative minimum tax, and the capital gains or estate tax. It would also eliminate the Internal Revenue Service. This does seem like an ideal measure of taxation to any average United States taxpayer. However, in order to make up for these tax cuts, Americans would have to pay a 30% markup price over the pre-tax of any retail goods. This includes any luxury retail goods and consumer staple products. Now, the likelihood of this consumption tax actually being put into practice is low. This is because the plan could cause a sudden abrupt change in the U.S. economy, for which Washington bureaucrats, lobbyists, and American business industry are unlikely to embrace. However, given political realities, it seems likely that luxury goods would be taxed at higher rates than necessity goods. Therefore, if this fair tax system were to actually be applied in the economy, it is probable that investing could sway from high-end luxury retail stocks and move toward consumer staple stocks. Because investors could potentially move out of high-end luxury retail investing and more toward consumer staples, we, as the investor, could expect to see negative revenue growth among the companies existing in the retail sector on the New York Stock Exchange. In turn, the investor could see decreased spending in luxury goods and services in the areas of luxury automobiles, motorcycles, boats, private jets, clothing and accessories, high-end furniture, and high-end restaurants. Some companies that may see a drop in stock price include General Motors, Ford, Boeing, Coach handbags, as well as Tiffany's jewelry, Ethan Allen furniture, and high retail stores such as Nordstrom's and Macy's. Since consumer spending will be more out of the need for necessity as opposed to luxury spending, investors could expect financial markets to be in favor of consumer staple trading. What would be classified as a consumer staple company? Typically, a consumer staple company is found in industries that manufacture and sell food, beverages, and household products. Therefore, due to the influence of the expensive fair tax on high-priced luxury items, investors could see a rise in stock prices and positive revenue growth in companies such as PepsiCo, Coca-Cola, Kellogg, Colgate-Palmolive, and Procter & Gamble. These companies could be considered by the average investor as necessity companies. One other important initiative that Mr. Huckabee plans to execute is placing a federal ban on smoking across the United States. As an investor, we could probably expect tobacco companies such as Altria, Reynolds American, and Vector Group to suffer in revenue growth. It would be wise for investors to stay away from these tobacco companies as they slowly became outlawed over time. Although conceptually, it makes the most sense to agree upon making it a national goal to eliminate smoking everywhere. The idea is just not practical to implement. In fact, by ending smoking, the United States government would actually be eradicating $30 billion in tax revenue that is used to finance government-sponsored health care programs. Thank you.
I hope this presentation will help you improve your financial decision-making power in this very important year in our nation's history. Thank you.
Thank you, Mr. Cavallero, and the members of the Investments Club. Let's give them one more round of applause. We now move to the second part of our program. Our keynote speaker, Mr. Henry Chip Dickson, is currently Managing Director of W2 Freedom, a private equity firm managing the Company Bank Strategic Equity Fund. Prior to this, he served as Chief U.S. Strategist of the Investment Policy Committee for Lehman Brothers. He was ranked among the top portfolio strategists in 2004 and 2005 and was voted an All-Institutional Investor, All-American Analyst 5 times. He has also been Senior Bank Analyst at Solomon Smith Barney, has worked for Kemper Securities and First National Bank of Chicago. Please join me in welcoming our keynote speaker, Mr. Chip Dickson.
Thank you. Tony said, why don't you talk about the Fed and what's going on in the economy? So the title of this presentation is The Fed, Housing, the Economy, the Dollar, and Markets, a whole lot of things. And thought I'd talk about the forces weighing on the Fed, recent statements by the FOMC, including today's, housing, our economy, some observations, the dollar, markets. But first, I came across this on the web. There's a website, a blog called Carpe Diem, which I enjoy. You can get a lot of information from it. They have graphs, things like that. And the point of this is things change. Things change not just for us, but for the Fed. You know, back in 1904, bathtubs were a growth industry. Only 14% of the households had them. Now, they're not so much of a growth industry. It was expensive to make a call. We didn't live that long, 48 years, so basically I've outstayed my welcome if I lived back then. The Eiffel Tower was the tallest building in the world back then. I thought that was pretty interesting. Annual earnings, $450. Today's dollar is $9,500, so we are doing better. Think about this. 90% of the physicians back then didn't have an education. So, wow. You know, leading causes of death: pneumonia, influenza, tuberculosis. If you go back to the 1800s, one of the big causes of death was bad teeth. So, you know, a lot of different things. Annual length of a recession, 22 months. Can you imagine a 22-month recession right now with our media? So, there's a book written by the former risk officer of Solomon Brothers. He runs a hedge fund now called The Demon of Our Own Design. I'm going to quote it a couple times. He says, the financial markets we have constructed are now so complex and the speed of transactions so fast that apparently isolated actions and even minor events can have catastrophic consequences. Things come out of the blue. And I think that's something to recognize. He talks about the increased complexity in the markets today and their tight coupling. That's apparently an engineering phrase, but it means that things can unravel pretty fast. And I think that's one of the errors. We're in that kind of period right now where things have unraveled pretty fast, a lot faster than the regulators and the managements ever thought they would. And certainly the Fed was caught by surprise by a lot of these things. So the forces weighing on the Fed are clearly the housing correction, the subprime problems which are tied to that. By the way, on the subprime problems, and I'm going to quote John Paulson, who's one of the most successful hedge fund managers of the day. His one fund was up over 500% so far through 9 months last year when I saw him speak. Subprime lending was $20 billion in 1997, and it reached $600 billion in 2006. So we did a lot more of it. The standards got a lot weaker too, and I'll give you one. They're called piggyback loans. Piggyback loans went from 15% or less of subprime lending back in 2001 and reached 33%. A piggyback loan is 100% loan to value for a subprime borrower. So you're taking on a lot more risk with a lot less cushion. That's something that they're battling. Because of these problems, you're seeing a credit tightening process, a credit crunch, if you will. You're also seeing concerns of an economic slowdown. We don't have what is called price discovery, and I'll come back to that, but that's a concept, especially you students want to think about some. That's something that the markets try to do, and when they can't, they have a lot of trouble. And you're seeing deterioration on those financial markets. There's a concern, and you've seen the unemployment rate pick up, but that'll pick up further. And now you've seen SocGen's loss. $7 billion by one trader. We thought after what we saw from Barings and things like that, it wouldn't happen again, but it did. So what should the goal of the Federal Open Market Committee be? And you can go to the St. Louis Fed website, and you can see this every day, and it changes almost every day. So as of like 3 o'clock today, or 2:30, it was 47% price stability, actually 32% maximum employment, stability of financial system, 13%. That's been creeping up. A strong $1.06, but that's also been creeping up, and 3% moderate long-term rates. These are all things that weigh on the Fed. Having a strong economy, they're trying to balance these things. You'll see different policies that they want to emphasize in their statements, and it'll come out. And the policy history has changed, okay? This is from Michigan's book, which I used when I taught global capital and money markets last semester. When the Fed started in 1913, by the way, before there was a Fed, there was J.P. Morgan, okay? J.P. Morgan got us out of the 1895 crash. Grover Cleveland called him up and said, help. And he said, okay, but it can't look like you're helping me too much because you're a Republican and I'm a Democrat. But they figured out. And then in 1907, he had to help out too. There's a book written on that. Well, when the Fed got started, they had something called the real bills doctrine, and really it operated more through the discount window. They didn't have open market operations. They discovered that in the 20s. Then they had to deal with the Great Depression, and of course, the fact that they dealt with it badly initially made it really bad. And you had, they didn't reflate. And one of the reasons I think Chairman Bernanke is so attuned to these things is he wrote a bunch of essays called Essays on the Great Depression. Now, I will tell you, I read the text. I did not read all of his analysis because they were PhD dissertations with a lot of statistical stuff in the back but it is worth a read, and he's very sensitive to it. So I think you're going to see a bias toward reflating all the time on the part of this Fed, and you can read that book. 1942 to 51, you saw war finance and the pegging of interest rates. Rates were very low into the 50s and even the 60s. In the 50s and 60s, we started targeting money market conditions, and I think that's when Mackenzie Martin was the chairman, and he was very well regarded. And then we started targeting monetary aggregates, and Chairman Burns and certainly Chairman William Miller, who served under President Carter, did not do a good job because of the inflation that we saw back then. And then in late 70s, early 80s, Paul Volcker came on, and he had anti-inflation strategies, and we took a couple shots at it, 2 shots in fact, but he broke the back of it with some help from the administration. And then in 82 and the 90s, there was a de-emphasis of the monetary aggregates. 90s and beyond, Fed funds targeting, much more open policy. We're hearing what the Fed's thinking. There's no delay in reporting what they want to do. They tell us immediately. There is more transparency. Indeed, one of the criticisms is that the Fed's transparent, but the market's not. So there's some concerns there. I would also tell you that Alan Greenspan was the first chairman to bring into Fed discussion, at least from what I've read about history, discussions about market conditions and how that should be affected by monetary policy. So this was the December 11th statement, and what you saw is they were concerned about the housing correction, economic growth, and strains on the financial markets. And there was one member of the board who thought that they should lower it even more. They should have been more aggressive. But then we came to last week, and they said, you know, things are unraveling a little bit more than we expected. And so you can see a progression. It's interesting to compare their statements side by side and see how the tone has changed. And so what you see here is that the committee took this action in view of a weakening economic outlook and increasing downside risk to growth. So that gets back to the economic stability. They don't want to see this thing falling apart too fast. And broader financial market conditions have continued to deteriorate, and credit has tightened further for some businesses and households. Incoming information indicates a deepening of the housing correction as well as some softening in labor markets. And they're not as concerned about inflation. So they're worried about, okay, we want the economy to continue growing. They're worried about this lack of liquidity in the market, the credit crisis, if you will. They're worried about reestablishing price discovery. And today they lowered 50 basis points. And they brought the discount rate down 50 basis points. But the discount rate, which is what banks can borrow at if they can't find any other place to borrow, is still higher than the 50 basis points higher than the Fed funds rate. Some people feel that that should be brought in line with it. So if there's real liquidity problems, they can go straight to the discount window. Again, they're still concerned about the financial market stress. SocGen had to have an effect there. And of course, you probably saw that UBS yesterday announced a $14 billion write-down. Recent information indicates a deepening of the housing contraction. And I'm going to get to housing in just a minute. And again, they're not as concerned about inflation. Richard Fisher preferred no change. He was a little bit more hawkish because I think he's probably concerned about inflation. Okay. So the Fed funds rate would be 50 basis points lower than this because this is from the St. Louis Fed website. It's Fred. You can make your own charts. You don't have to do them all in Excel. You can go to Fred, and they'll do it for a number of these economic statistics for you, and there's a lot of ways you can change that. So I got that from the St. Louis Fed website. You can see we're retracing a lot of what the path up from that started under Chairman Greenspan. Oop, that was bad. Okay. And here's the 10-year Treasury rate. I wanted to put this here just to give you a sense of where we are on long-term rates. We're about as low as we've ever been since 1960. In the 50s, they were lower, but long-term rates are very low. They were extraordinarily high back in the late 70s, early 80s. That was the period of the great inflation, and they've been coming down since because inflation has been taken out of the system. And the question is are they going to go up again? I would tell you one of the forces that will cause it to go up again is less, I think, what's happening in this country, but more what's happening externally. So housing, this is a concern for the Fed. Now, this comes from GDP, so this is more building houses, but you can see that it's really pulled back. We're back to levels that we saw back in the late 90s. It wouldn't surprise me if we got to the mid 90s. We're declining. We overbuilt. There was too much speculation in the space, and so this is an area of the economy that is not going to supply the growth that it had. It's under 5% of GDP, but it is not expected to be a source of growth. And of course, one of the concerns is, and this is a bear case, by the way, that the median price of a house is very high relative to median income. So a lot of people feel that there's always a tendency to revert to the mean, and this really scares people. I would tell you we're probably back closer to, we're under 4.5 now. We may be closer to 4 right now in terms of median price and income. And if Mr. Schiller's or Professor Schiller's outlook is correct, we are probably close to 4. This is what they published yesterday. This is the Case-Shiller Home Price Index. We were down over 8% in national prices. Professor Schiller says we're going to lose about $1 trillion of value in our houses. To give you an idea, Household America has about $11 trillion, just under that, of net worth tied up in their houses. So he's expecting about another 9% kind of decline. Why is this a problem? Because the principal sources of household wealth are two things. They are your house, and they are financial assets. Fortunately, financial assets are a lot greater than housing. Housing, as you can see here, is about 20% of household net worth. Given where we are, though, with the outlook for housing, we can't depend on that as a source of wealth creation going forward. And that's a critical point I want to make. Wealth creation, and use the growth rate as the blue line, the dark line, that's household net worth, is, I think, a significant factor in generating income growth. You need to create wealth to get income generation to go up. The consumer is 70% of economic growth. If the consumer starts feeling less wealthy, they are going to spend less. And that's going to put a lot of pressure on the other 30% of the potential sources of economic growth. By the way, ex-real estate, residential real estate, real GDP growth was almost 4% in the third quarter. Why was that? Well, real consumer spending growth rates and durable goods was strong in the fourth quarter, while you would see non-durable goods, the pink line, slowed down a bit, and services stayed about stable. These weren't your principal sources. Consumer spending was up, but it wasn't the principal driver of the strong real GDP growth. By the way, if you take these time series back to the 30s, just after the Depression ended, what you would see is real consumer spending almost always goes up. The least volatile series is services, followed by non-durable goods, followed by durable goods. One of the sources of growth has been non-residential fixed investment, and you can see structures has been very strong, and that's one of the, in other words, there's a lot of activity in corporate America. The equipment slowed down a bit. These are more volatile series. You can see what happened when the market bubble burst and a lot of spending was taken out. But this is one of the sources of growth. I'd say if the consumer slows down enough, these guys will follow. The Fed, I think, is thinking, well, the consumer has enough pressures on them also. Energy is going up as a percent of disposable income. Healthcare costs are going up a lot, so this is a political issue. There's got to be some kind of solution. It's, over 15% of disposable income, and it looks like it could be headed higher. I mean, we're getting older. The services we're using are more sophisticated. but also there's still a lot of bureaucracy and other burdens. And believe it or not, on a pre-tax basis, our taxes are at about as high a level as we've ever had, at least if you take taxes and our social insurance relative to personal income, they are. And the period they were higher than really was tied to the market bubble, where we had exaggerated valuations and probably capital gains taxes were at their highest level. They appear to be going back to that point finally. And options-related income was there. We're at a very high level of taxes already. So I think when the Fed thinks about the consumer, the Fed thinks pressure from housing, at least psychologically. Still a lot of that net worth there, but it feels like prices are going to go down, and we're reading bad news every day. And energy prices seem to be going up. You don't have them going down the way they did in the 90s. You have healthcare going up a lot. So there's a lot of pressure on the consumer. I think the Fed's sensitive to that, and that's another pressure on them. So where's our growth coming from? Well, you might be surprised to know that the U.S. is a much smaller share of the global economy than it was back in 2000, 2001. We're going under 25% here. In fact, the rest of the developed world has also been declining. As you might expect, Brazil, China, and India have been growing. And the result is that global economic growth on a real basis is expected to be about as strong as it's ever been for as long a sustained period as we've ever seen in our lifetimes. And that's because much of the developing world is really growing a lot. That's where some of the cost pressures could come from, but that's where a lot of the growth is. China last quarter grew over 11%. And if you go, that's from the IMF, and you can get this on the IMF webpage. Green means slow growth, brown means fast growth. So you can see where and the darker the color, the faster the growth. You can see where the faster growth is. So it's a very much of a changing world, and this is something else that the Fed has to deal with. It's not just a U.S.-centric world anymore. You saw not only are they lowering rates, but there were other policy issues that they took on, and they've worked with the European Central Bank to try to enhance liquidity in the market. I think the Fed is somewhat concerned about the dollar, but the trend hasn't been good for a long time, and this is related to the major currencies. I like the longer time series. It has been weak. It seems to bounce around, but the dollar clearly has been losing ground. And I'll get to that. So the markets. Well, there's two quotes here I want to focus on. Virtually all mishaps over the past decades, and I'll say the past 2 decades, have had their roots in the complex structure of the financial markets themselves. Again, Richard Bookstaber in A Demon of Our Own Design. If you like a more classical financial writer, you might look to Peter Bernstein. He would say about the same thing. And so, and then Charles Handy, who's a minister and economist, he wrote something called The Hungry Spirit. And he says, we have allowed ourselves to be distracted by the false lures of certainty. One of the things that I saw as a strategist when I was on Wall Street, and one of the things you have to be sensitive to, is you can do all the forecasting you want, but that's all it is. It's an opinion. It's not a fact. Because you come up with a number doesn't make it a fact. And don't, always challenge yourself. And you see that a lot of the push toward quantitative analysis, there's almost at times too much certainty put in it. You got to challenge it because it can fail you. So what are some of the problems we've experienced? And I'm going to just step away from the mic. Clearly, this is the market bubble. This is the stock market euphoria. That's a financial problem. Back here in the 94-95 time period, that was Latin America, Argentina, and Brazil problems. 91, 90, I was a bank analyst back then. That was the S&L crisis, financial problem. 87, portfolio insurance and the dollar going down. Portfolio insurance, by the way, is also another word for dynamic hedging, and it didn't work the way they thought it should. So it's not until really, and back in 84, you had Mexico having problems. So it's not back until 82, 83 where you can say, hey, we're back to things like that, or say back into the 70s when you had energy crisis and we took the dollar off Bretton Woods. Financial problems have resulted in a lot of, where you've seen the market get weak and where we've had economic problems. But how's the S&P look today? Well, this is looking at the trailing PE back to 1960. You can get this off the Standard & Poor's website, and it doesn't look expensive. In fact, if you go on Standard & Poor's, you can pull down the earnings estimate from a bottom-up basis, and you can see it looks like around 13.7 times. Bump it up a little bit, it's still not that expensive. And the 10-year, remember, is at an all-time low. The Fed model says that we're almost at the bottom of the range, that the S&P looks attractively valued. But the action's been in the global markets. Okay, World Federation of Exchanges. This surprised me. Global market cap bottomed at around $20 trillion in 2002 and hit over $60 trillion at the end of 2007. If you were in a global balanced portfolio, you got 25% compound returns in that 5-year period. Now, that felt a lot better than if you were just in the U.S. markets. One of the reasons is because the dollar went down. So, the principal reasons I want to leave you with this thought from Mr. Bookstabber, that prices vary, especially in the short term, is liquidity demand. Not only does the demand for liquidity move prices, but it, and not information, is the primary driver of prices. Liquidity's been taken out of the market. We're having trouble reestablishing prices at times for things like financial and services institutions and some kind of loans. So the summary is the Fed's battling a liquidity crisis. There's more global issues here, and it's trying to reestablish the environment where price discovery exists. The source of rising household net worth appears tied to increases in financial assets, as home prices are expected to continue falling in 2008. That, to me, says they'll remain accommodative. I don't think that comes as a surprise. The market, S&P 500, appears attractively valued. You also should be looking at the mid-cap 400. A declining economic share on the part of the U.S. means a less dominant position for the dollar. You can talk about our imbalances and things like that, but one of the other pressures on the dollar, I think, is that our economic position in the world is changing. It's not necessarily bad, it's just changing. And then finally, as you think about managing your own portfolios, think about being a little less U.S.-centric in at least your view. Thank you.
Thank you, Mr. Dickson. Let's give him a big round of applause. I would now like to call to the podium Dr. Karen Boroff, Dean of the Stillman School of Business. Dean Boroff.
Good afternoon. What a pleasure it's been so far, sitting back enjoying learning. The numbers. What's the big number? You do the math. What's the bottom line? It doesn't add up. Numbers, they populate our vocabulary all the time. Almost everything we say, what's the number? Is counting intuitive? As humans, is counting intuitive? Or did counting and numbers and math and numeracy come about in response to some problem we had as people? We know that cultures have different numbering systems. Some exist today, some are long gone. Many cultures had a single stroke indicating the number 1, regardless of the language spoken now. And we know that some old systems survive. Just think about how we are counting the big game this weekend. I'm sure the Romans would be happy to see that their number plan still works. Today, we've talked about the numbers. We're going to talk here about more numbers. But before we do, I'd like to thank Jim and Judy OBrien for their gift to us. People have made the difference to make the sense out of the numbers. And Jim and Judy, I'd like to thank you for your gift Your gift has changed our school for the better. And your gift has also brought to us gifted people to help us find meaning in the numbers. We have a small token of appreciation. We hope that it'll help you write really good numbers, good stories, interact with people, and also as a token to help you remember how we have benefited from you and from this colloquium. I'd like to now turn it back over to Sophia.
Thank you, Dean Boroff. We now move to the third part of our program, our panel of experts. Our experts will be offering a microfinance perspective of political and Federal Reserve issues for investing in 2008.
You're with me, Doug.
I want to be Cody, the cool guy.
I don't have his hair either.
To my far right, in the order seated, we have Mr. Tony Dwyer, Equity Market Strategist at FTN Midwest Securities. Mr. Douglas Kass, founder and president of Seabreeze Partners Management. Mr. Scott Rothbort, president of LakeView Asset Management and finance professor at Seton Hall. Mr. Gregory Peters, chief U.S. credit strategist at Morgan Stanley. Mr. Brian Reynolds, chief market strategist at MS Howells. Mr. Cody Willard, who we expect to arrive shortly, is a co-host of the Fox Business Network and formerly of CL Willard Partners Capital. We now begin with Mr. Dwyer. He joined Midwest Securities in June of 2003, where he is also currently chair of the investment committee. He has begun his career at Prudential Beige in 1987 and has served as equity market strategist for a number of regional brokerage firms. He is often interviewed and quoted by Fox News, CNBC, CNN, and Bloomberg Radio. Mr. Dwyer?
Thank you. Am I supposed to say something?
Yeah, you know what? Do me a favor. Why don't you just introduce everyone, and then we'll just take the panel from here.
Was it something I said?
No, just don't worry about it.
Mr. Douglas Kass, in addition to being president of Seabreeze Partners Management, has held high-level positions at DeMoores Capital Management, Kass Partners, and Omega Advisors. He is also a principal contributor to TheStreet.com, Street Insight, and appears on television programs and is a guest host for CNBC's Squawk Box. Mr. Scott Rothbort, in addition to being president of LakeView Asset Management, he is chief market strategist and professor of finance at Seton Hall. He is also a frequent contributor to TheStreet.com and is a guest on Bloomberg Radio, Bloomberg Television, CNBC, and Fox Business News. Prior to founding LakeView, he held positions at Merrill Lynch and Morgan Stanley. Mr. Gregory Peters will provide a fixed income perspective today. Prior to his position as chief U.S. strategist, he was a co-head of North American Credit Research, where he led a team of high-yield and investment-grade analysts. He also worked in the Office of Thrift Supervision and Solomon Smith Barney. In addition, he has been widely recognized and regarded by the Institutional Investor magazine. Mr. Brian Reynolds, prior to becoming chief market strategist at MS Howells, was a chief strategist at Curlin Holdings. From 2000 to 2003, he was the fixed income and economic columnist for TheStreet.com. He spent 16 years at David L. Babson, an investment counseling firm, and was senior vice president and portfolio manager there.
Thank you. I've had it locked away in my desk for the last year, my notes from last year's colloquium, and so I thought we kind of begin by looking at the minutes of last year's meeting, just to show you.
That's dangerous.
I know, that's why I figured we talk about it, Doug. Jeff, who's not here with us this year, his favorite stocks were Boeing, UNH, WellPoint, and Apple. He thought the S&P would be up 10% or 140 points. Cody, who hopefully will be here soon, his favorites were Microsoft and Adobe. He said to avoid Comcast, which was absolutely on target, and I would continue to avoid Comcast, and to avoid satellite TVs. He thought the S&P would be up 15% for the year. Doug, your favorite was Adobe. Your least favorite was Zales. We both hated that one. And American Greetings, another one, your least favorite stocks. The S&P you thought would be all a function of second and third quarter earnings. Tony, your favorite was IT and consumer discretionary as well as industrials. Your least favorites were energy and materials. You thought the S&P would close at 1650. Brian, you were cautious short term, which pretty much was on target, and you say long term, multi-year, the S&P 500 will get to 2200, and we pray that it will. Myself, my favorites.
S&P will get to what?
2200. Multi-year. My favorites were Apple, the brokers, Google, and Sears. My least favorite was Amazon, and I thought the S&P would get to 1610. Well, here we are a year later, and you know, why don't we talk about really what's going on in the marketplace? I mean, it's absolutely amazing to me how poorly this year has started. It was an absolute shock. It was kind of waking up in January and finding out, you know, that your wife was cheating on every one of your best friends, and you didn't know about it. And here we are, just barely a month.
She didn't tell you?
Wow. Nah. Yeah, but I got all the money hidden in the Cayman Islands. And so yeah, what's going on here? Because certainly there seems to be some major disconnects, and the Fed is aggressively cutting rates, and the federal government is going to be injecting some fiscal policy. So what's going on, and what's the source of this confusion? Brian, want to start that off?
Pull up one of my slides there.
Okay.
Well, I got a few slides. Some of them I've shown the last 2 years here, and some of them while they're the same slides, they look radically different. I've always started off with this one as kind of, it's a nice takeoff from what Chip was saying, in that leverage has really increased in our financial system in this decade. This chart shows credit derivatives versus the value of the stock market versus the value of corporate bonds. Credit derivatives, you know, are the derivatives of corporates. Corporate bond market's about $2.5 trillion. There's over 50 trillion notional of credit derivatives out there. Now that overstates, you know, how big credit derivatives are, because these things trade, you know, don't trade at full face value. But the growth rate in them has been tremendous, and they lead the credit markets. And so the last few years, it's been crucial to figure out which way the credit derivatives are going, because that leads the credit markets. And if you flip to the next one, Scott, I've shown this one the last couple of years.
This is my favorite one, by the way.
Yeah, this shows, you know, the stock buying and selling. I've shown this, you know, every year now for the last 3 years. We've never had buying from any group of investors on the scale that we've had buying of from companies themselves during this bull market. That has been the driver of the bull market. There's about 20 other series in this Federal Reserve data. They're all dwarfed by these two series. So the buying of corporates by companies themselves has driven stock prices higher. At the same time, this decade, we've had a massive shift from long-only fund managers to hedge funds. And I made this point last year. Every $10 billion that a CalPERS shifts from a long-only manager to a typical 60-40 long-short hedge fund, it requires $8 billion in selling for every $10 billion they shift. Because if they go from long-only to 60-40, they've got to sell $4 billion to get the cash and another $4 billion to get to 40% short. The thing about how it's changed is you look at the buybacks, they've started to roll over. And if you think about it, all the big financial companies, and this doesn't include financials, you know, they've gone from net buyers of stock to net sellers of stock at depressed prices in a hurry. And the reason is, if you go to the next chart, here's an index of credit default swap spreads on the major brokers. And back in October, you know, when I was here last year and the year before, I was pretty bullish based on where corporates were relative to the stock market. But in mid-October of last year, we put in a new high in the stock market. It looked like we were going on a year-end ramp, but I said, hold it, time out. We're getting another attack on the credit derivatives, and this is going to be the biggest one yet. And since October, you can see what the credit derivatives have done. they've gone through the roof, which leads us to the next one, which is actual credit. Here's a chart of junk bond spreads, and you can see how it's just gone vertical. Credit spreads have doubled in the last 3 months or so. They've gone from 300 to 700 basis points. If you look at that chart, it looks almost as bad as the '98 crisis. So this is a disaster. And then fast forward to this year, you know, what a surprise it was to a lot of people. January is so important to corporates because you always see a surge in issuance in January, and how that surge in issuance gets accepted by the market is a big factor going forward. On day 3 of this year, I said, sorry, corporate bond investors aren't going to be allowed to participate. And the result is this chart shows valuation, earnings yields, which is the inverse of PE relative to junk. This time last year, stocks were the cheapest ever against corporates. It's fallen off a cliff. So we're on the edge of history. We're either going to have a '98 experience where we go roaring to the moon in that 2,200 over the next couple of years, or we're going to collapse and it's going to be worse than '01 and '02. I'll leave it there. We can come back to a couple of other ones there.
Sure.
But generally, we've had a massive attack on credit derivatives since October, and if that doesn't change, we're looking at a disaster.
Now, Greg, you're new to our panel, and welcome. Yeah, certainly, based upon your background, you may have some things to add to, or perhaps you have a diversion view from what Brian has. So why don't you tell us what you think, especially vis-a-vis what's going on in these credit derivative markets?
Yeah, I think the markets are like this auditorium. It smells horrific, but they're trying to mask it with the spray in the back. No, look, I think it's just a general risk reduction trade. There's a lot of talk about credit derivatives. I think there's very little understanding of it. But what I think is important here is, and not you, just generally. What I think is important here is that the market is in just deleveraging mode. And so look for the asset classes that have the most leverage embedded. And that's really in the credit space. And so we're seeing a re-risking, a reduction in leverage, and that's creating all this volatility in the financial system. Keep in mind that the credit component of the financial system has just grown exponentially over the past couple of years. So the importance of free and easy credit and the trading of that credit has probably never been more important than it is today. So the dealers, Wall Street holds a lot of that risk. And so as these losses mount on the subprime side, which is really the canary in the coal mine at the end of the day, it causes even more deleveraging. And losses continue to mount, which puts more pressure on pricing. It's a self-fulfilling kind of downward spiral, and that's where we are. And I think what's important to remember here is that the access to capital has really dried up. And the system has really been reliant upon free and easy capital. And that's changing dramatically, not only on the corporate side, but on the consumer side. And the knock-on effects to stock positions, overall economy, and the financial system, I think, will still be felt.
Can I just add on to that? Because that reduction in liquidity that you talked about, I think that's a great way to phrase it. And I think the best way to illustrate it is if you look at a chart of the assets in Treasury-only money market funds. These are money market funds that invest in the safest things. Their assets have been going through the roof. Clients have been taking money away from the bond managers and putting it in super safe things like stuffing it under the mattress. And that's what needs to stop in order to turn this around. And if it continues, then that deleveraging is going to continue, and we're just going to spiral downward.
At LakeView, I manage a small portion of our overall portfolios in fixed income for high net worth individuals, and primarily what we have is just a portfolio of short-dated corporate bonds and some preferreds. To some extent, we've been able to take advantage of the reverse convertible product that's been very popular. But clients really don't understand why, when interest rates were going down last year, why their portfolios weren't really performing well, and that's another major disconnect, I think, with the individual investor. Why is it if all of a sudden, as we saw before in Chip's graph, that the longer bond average yields are declining, when if you're putting your money into a pretty decent quality corporate bond, all of a sudden you're getting whacked last year, and that, I think, is just another one of these weird messages that the individual investor is receiving. They don't quite understand kind of this bubbling below the surface. What's happening with these credit markets?
Well, that's just a classic illustration of a panicked flight to quality, the deleveraging he was talking about. When Treasury yields go down and corporate yields go up. That's people selling those risky assets and seeking out the safe assets. So a decline in Treasury yields may look great for valuation, but I'll tell you, it's an absolute disaster for stocks because corporate yields are going the opposite direction.
Oh yeah, and, last year I was selling, B of A 6.5s and then buying them 2 weeks later when they issued a new 7.25s. And that's what the market was like. How about this end of the table? What do you guys think?
You want to go first? Sure. We're in a calamitous situation. It was all started by Alan Greenspan, who took interest rates to levels that were extraordinarily low by historic standards or any standard. And the housing market looked fine prima facie. Interest rates were low, employment levels were high. But Greenspan encouraged a new class of asset buyers of homes, and that was speculators. Toll Brothers, the third largest home builder, woke up one day and realized in its most important market, South Florida, 75% of its buyers were non-owner occupied buyers. They were traders in homes. In fact, the traders in homes were the same guys who were day traders in the late 1990s and were responsible for the last bubble. Affordability was stretched to a 2 or 3 sigma event, the relationship between home prices and household incomes. And in that search for yield, when interest rates were going lower and lower, what Brian fails to mention is that the hedge funds that got all that money levered up, because that's the only way they could get adequate returns relative to their compensation of 2% management fees and between 20 and 50% carried interest in the profits. All the while, a very small army of people, some of whom work for those people on this dais, but we know who they are. They're at Goldman Sachs, and they're at Merrill Lynch, and they're Morgan Stanley, and Citigroup, and J.P. Morgan, for very avaricious reasons, provided new products, and we developed basically a shadow banking system where the derivative markets bypassed the traditional regulatory and capital requirements that the financial institutions, bank thrifts and savings and loans, had to operate under for a century. So you had a small group of guys making $50 million to $100 million that screwed up the whole system. Let me put it into perspective. It is unbelievable that Stan O'Neill, the outgoing and deposed chairman of Merrill Lynch, isn't in jail for fraud. And the same is true about Chuck Prince at Citibank, who did, hi Thomas, I didn't even see you over there, who did nothing different. He was no better than, who's the guy, Schilling at Enron? Tom? Skilling. Kurt Schilling's the pitcher for the Red Sox.
Well, but in New York, a lot of people want him in jail.
He just took steroids.
Yeah, Red Sox stuff. So Skilling, he did the same thing with structured investment vehicles. It's Citigroup, these amazing levered products off the balance sheet that orbited around Citigroup. Put it in all into perspective to summarize, Stan O'Neill presided on and many of these people were icons. They were no different than the internet icons of the late 1990s that blew up. Merrill Lynch, under the supervision of Stan O'Neill, started, I believe, 2001, January, with shareholders' equity of about $39 billion. In the first 3 quarters of 2007, the company wrote down $22 billion. Think about that for a second. Merrill Lynch, Mother Merrill, is the way Merrill Lynch used to be called because it was a nepotistic franchise that stuck to its knitting and sold stocks and bonds to older people and businessmen.
And
Look, it was bringing Wall
Right.
Street to Main Street.
Right.
I worked in Merrill Lynch for many years. That was
Right,
it.
and you did.
That was.
But think about that, starting the year with $39 billion of equity and writing off $22 billion of it, and leaving with a severance package of $60 million. I mean, it's remarkable what goes on in this business, and it happens every cycle. It started when I was in the business in the 1980s during the junk bond craze, and Michael Milken, who also went to jail. So we're in a calamitous point of time. Brian's very right. It's an inflection point, and we don't know which direction it's going to take. But one thing that came out of this seminar last year, this panel last year, was we disagreed on almost everything. I certainly did. But the panel agreed on one thing, that as credit went, so would the capital markets, specifically the equity markets. Today the Federal Reserve, I don't want to hog it, this Federal Reserve cut interest rates, not surprisingly, by 50 basis points. The S&P at one point was up 2%. There was an intraday swing today in the S&P, because these guys aren't even aware that the S&P is down 15 points after the close, because S&P, in their infinite wisdom, decided to downgrade $300 billion of CDOs. So you had about a 4.5% intraday swing. Not something that exactly engenders security on the part of the individual investor. So we don't know where it's going, but I suspect the upside is limited.
Everybody, first thanks Jim and Judy for hosting the show again this year, and certainly Scott for putting together the program. It's great, and honestly, I turned to Scott during the presentation that you guys gave, and I said I want a copy. I now know what the candidates, after watching them, every day for the last year, now I know what they're looking for. I had no idea. I mean, they did a great job. I'd love you to send it to me. In terms of last year, when the market got up to 1560 by October on the S&P, it was a very good time. Last year was mostly a good year until, as Doug pointed out, the credit market deteriorated. You had pretty solid gains. You had 15% plus gains in the market. Everybody was pretty happy, but all of a sudden the credit market, even though the Fed was beginning to ease, the credit market didn't improve. By credit market, it's what, the ability of a financial institution or the willingness to lend to a business for growth. Funding businesses for growth. That's in English kind of how I put it. Scott, if you could pull up my presentation real quick. There's a bunch of things, a couple of screens I want to show.
You did do a presentation.
I always do.
So organized.
Go down to interest rates. Keep going. I'll tell you when to stop. Let's go one page at a time. Keep going. Keep going. Keep going. Keep going. Keep going. Right there. That chart is the key to what has happened and what I think is going to happen. My two worst picks, when it goes down and I'm almost dead, and they asked me what my worst call was in my history, it's going to be absolutely being negative on materials and energy too early. I continue to think I'll be right. What has happened in this cycle is, and I'm going to stand up to show you this, those red arrows are interest rate increases on the 10-year note yield, okay? What you wouldn't see visually there is from the low yield to high yield, where that yellow circle is, from that low to high, you had a greater percentage increase than any of those four red arrows. It took a year and a half longer. So what's happened in this cycle is, instead of having this sharp rise in rates that really crunched the economy, people don't borrow, financial institutions are less willing to lend, you don't have a buildup of significant excesses, okay? You have a buildup of excesses, but they're not significant. What's happened in this cycle is, instead of that spike that really slowed down the economy, in other words, it's easier you're going to go take out money at 5.25% versus 7.25% interest rate. It's just cheaper to do it in plain English. So what happened is, it's sort of like, I like to put things in real terms. My son I have two sons, 11 and 13. They were here last year. I do not watch them grow every day. To me, they look exactly like they did a year ago. But if you guys saw them this year versus a picture last year, you'd be like, wow, those kids got big. That's what's happened in this cycle. We're not watching the slowdown and the deterioration happen because it's happening slowly, and we're watching it every day. And all of a sudden, we walk into October, and it was like, ooh, that problem's big. That's exactly what has happened. And where I'm concerned, and I think
the greatest risk lies not necessarily even in the financials, because the Fed is aggressively addressing it. Finally, I've renamed Helicopter Ben. Ben Bernanke was named Helicopter Ben because he said all you have to do is print money and drop it from helicopters. I renamed him Submarine Ben because he was dragging everything underwater. Now he's back above water as Battleship Ben. So that's kind of how I'm allocating my strategy. But what's happened is that slowness of the slowdown that we kind of didn't notice until October is really kind of hitting us hard. And he's finally getting the joke, as Brian pointed out, on the credit. It had a better day today. All right, so this slowdown is happening, and now we have a problem. Okay, the problem we see in the U.S., it's pretty simple. You have the financial institutions in trouble, and consumers don't have any way to get money. Typically, after that red arrow up, you get a big drop, right? When that happens, people like me refinance my debt. I refinanced my loan. I actually did this last Wednesday. All is not lost. I refinanced my mortgage, right? I saved $300 a month, right? But that's typically what happens to everybody when rates come down. That's not going to happen this cycle because of the subprime mess, as Greg pointed out. It's a mess. You're not going to get people to really refi down as much as the pain is going to be less when you reset up from these teaser rates. Okay, so you don't really have any way to get the consumers real money. And I'm talking about, there's three ways you can get it: disposable income or jobs. You can get it from a Reagan-Bush kind of tax cut, which we're definitely not going to get, okay? Or you can get it from refi boom, which you're not going to get. So all we have is our jobs. So the good news is we're at full employment. 5% unemployment rate is full employment. Could you go to the last slide? The problem that I have in the market, just hit end on your computer, up on top there. There you go. Okay. What I did and what Chip didn't show you is what I did to put into perspective how big the U.S. growth is, or how big the U.S. economy is globally, is I got this chart that was put out in the middle of last year, and what it did was it took all those countries that were in orange on Chip's slide, and it put it on a U.S. state GDP. So if you're betting on Russia being the net savior for the global economy because of their oil, et cetera, you better bet on New Jersey, because it's the same size economy, okay, in a global GDP state. So you're getting, yes, a much higher growth rate globally, but remember, those excesses got built up. So now all the excessive speculation is in commodities, in global growth, and energy, and this is a permanent thing. It's not a permanent thing. And the risk that I think we have in the marketplace, and I got a lot more cautious on January 6th because of the credit market issues, if you allow me, Scott, because I know where it is. This will be my last one, and I won't hog one more time. Okay, a couple more slides, actually. This is a slide that shows you the behavior. The problem in the market, and that you guys as students, you got to realize this. It's not in a book. You've got to look at what pragmatically works. And what pragmatically works is, in the stock market, I don't care what the economics are like. I'm a macroeconomic analyst. You've got to look at whether there's more buyers and sellers, and where are those buyers coming from. There's two sources, U.S. investors. Well, guess what? That black histogram shows you there's an outflow of U.S. investors, which means mutual funds are not net buyers. Where you put your money is not net buying, it's net selling. So where's the net buying? Brian showed it on that blue chart. It's companies are buying back their stock. When you have credit market dislocation, they don't borrow to do that. Bottom line is you don't have any buyers. You can talk all the economics you want. There's no real buyers. The good news is, as I said before, interest rates have come down, and most people are like me, in some ways, bald, middle-aged. Most people aren't leveraged to a subprime loan in a house that's upside down going to zero. I got a call this afternoon from a friend of mine who said, should I refi now? I begged, and I said yes. She said, I'm going to save $600 a month. It's not so bad. So I don't think everything is good, but I also don't think everything is an Armageddon. I think we're going to be kind of bouncing around for a while, but when the Fed eases like this, ultimately it's stimulative, because people get more comfortable, they're not going to get fired, and they end up spending that excess money. So
I want to build on what Tony said and what Brian had in that chart. And what I did was I put together here a comparison of the S&P 500. And we can all relate to this
as individual investors, looking at the S&P 500 versus annual returns. And I contend that we have been embedded in a bear market since 2000. This will be, according to my definition, the longest bear market that we have ever had on record. We are now entering the 9th year of a bear market. And how do I define it? Well, I look for clusters of periods where we have underperformance, overperformance relative to the mean of the S&P 500. So what this chart shows, it shows the annual price returns for the S&P 500, price returns only, and where you see the numbers in red, that's our years in which we're down, and the years in black are years in which we're up. Now, so far since 2000, we've only been up 2 years. And everyone seems to think that we began a, the numbers in red are those in which we've underperformed the S&P 500, whether or not we've been up or down. With the average annual return of the S&P 500 is historically 9.26%. So even though, for instance, in 2004, we were up 8.99%, I show this in red here. And what this shows is a lot of people think that we really started a new bull market in 2003. I think that all the 2003 was just a snapback year after those horrible years we had in 2000, 2001, and 2002. Looking at this another way, what I've now done here is I've taken the annual returns and I've subtracted from that the 9.2% annual return that the S&P averages. So now where you see negatives, it's underperformance. We have underperformed the average return of the S&P 500 since 2000, which is 8 years. It'll now be 6 out of 8 years, and probably it looks like 2008 is going to be no different. So we will have underperformed 7 out of 9 years. All right. Looking back in time, there were very few clusters in time in which we've had that kind of underperformance, and those clusters of time actually happened to coincide with other bear markets, like 1990 to 1994. And we've talked here today about a lot of the problems that took place over that period of time. 1973 to 1977. Boy, if anybody was around when Jimmy Carter was president, knows exactly what was going on during that period of time. Now, we had some years of outperformance, and certainly 1995 to 1999 was party time on Wall Street. Everybody was putting money into the market. The market was going up constantly. Right? All you needed was basically a machine and a bank account, and you could make money. That's not so easy now. And so what I see is we're having this prolonged period of underperformance, and that's forced people to do with a few things. First of all, what they're saying is, well, why should we put money in this market when it's really not performing well over long periods of time? And so what's happening is people are pulling that money out, as you've all seen. And what's happened is a lot of money has gone into alternative investments. And slowly what's happened is that the ability of the markets to be controlled by the individual investor, either directly through their investments at a Merrill Lynch or Smith Barney, or through mutual funds, is now slowly shifting. And it's slowly shifting to hedge funds, to alternative investments, which tend to be levered. And they've got to move money around fast, and they've got to clip quick returns. And so we've had this whole change in demeanor of the market. We've underperformed tremendously, and I think we're still in this bear market. I think we almost snapped out of this bear market, and that happened, as we all said, kind of in October of last year. That seemed to be the precipice upon which we either were going to snap out of the bear market, or we're going to go into another bull market, and we failed. So now we're back marred into this bear market, and frankly, investors just don't want to put money in. And if you compare this against returns on the 10-year U.S. Treasury, the 5-year U.S. Treasury, it looked even worse, especially over the course of the last few years as those rates have come down.
This is an average relative to the 9%?
That's right. That's right. So if you take the returns, the
Well,
page...
do you have an absolute return?
That's the absolute return there, on that page. This just subtracts 9.26% from it.
You go to the first one.
Okay. Right. So that's how we've performed. In red's where we've underperformed the market.
You call that a bear market?
I think this is a bear market. I think we've underperformed. I think we've underperformed tremendously.
There's a difference between a bear market and underperformance.
But what I'm saying is that taking out 2003, which was but on a relative performance basis, okay, this has been a bear market. This has been a market.
It's not a bear market the last 7 years.
Well, it's not if you are a technical analyst.
all right? But I think if you're out there managing money, and basically this market's underperforming its historical averages, who wants to throw money into this market? And it's turned into a market where really you have to either be very swift and be a trader, but a lot of people just don't want to be traders, and money managers don't want to be traders. We want to be kind of typically, you know, a buy and hold or long-term investors. So we've had to become very good stock pickers, and that's what's kind of separated everyone. So I'll kind of leave it at
Scott,
that.
an interesting thing that if you pull my slide back up that showed U.S. investment and U.S. funds, you know, I think you're giving too much credit. Hedge funds are obviously very big and becoming bigger, but I think what people have really done is they've chased that one. What they've done is they've chased performance. First they chased stocks, that blew up. Then they chased bonds, that blew up. Then they chased real estates, that's blown up. Now they're chasing commodity in international markets, and that too will blow up. When people en masse chase performance, it's never good. And what you can see in that chart is what are individual investors doing? They're selling U.S. stocks and U.S. mutual funds to buy international mutual funds. Who in here has bought an international mutual fund in the last 3 years that hasn't owned one before? At least one person's brave back there, right? I mean, it's the truth is there's a huge flow of funds in international markets that are less liquid than ours that expect these permanent returns that the TV guys taught myself. You know, I'm a TV guy. Talk about, and I think, you know, if there's a risk, you know, our job isn't just to say what's happening and what has happened. It's trying to predict the future, which is an impossible task. But, you know, my main prediction in the next few years isn't the demise of the U.S. It's the demise of the concept that the globe is going to grow when 3/4 of it's almost in recession. Japan is negative. Germany is certainly going to be negative, which means that Europe's negative, and we're darn close to it at 0.6%. So somebody's got to explain to me how there's a permanent growth rate overseas. And that, in our view, is the real message.
One thing I just want to throw out, though, away from the individual investor, is that there's a new investor out there that's massive. It's called sovereign wealth funds. I'm not sure if anyone in the audience really knows who they are, but
They now own Merrill Lynch and they own Bear Stearns.
yeah, if you think
They're
about
buying
the
US
capital
assets.
that was injected into the financial system, it clearly came out of that region. So that's the Middle East, Asia, really are the two areas. So that is a massive slug of money that is much more stable than the retail investor that I think puts a floor on valuation as they're looking to buy U.S. assets on the cheap.
So let's examine how smart they are.
Well, they have a 99-year holding period. You know that?
That's what?
They have a 99-year holding period.
Well, that's the easiest. You know, Bernard Baruch said, "In the long run, we're all dead." So let's examine. The Dubai owns what, 5%, 4.9% of Citibank. They paid basically, it works out to around $36 a share. Citibank sold last Wednesday at the Sojin market bottom at 22 and change. The same group bought a 11% interest in Blackstone at 32 a couple months ago when Blackstone went public. That stock is now trading at 18. Another sovereign wealth fund bought a 12% interest in Oxif, the last hedge fund. Denny Ock came out of Goldman Sachs Asset Management, and they paid 32 and a half, and I know that one because I'm shorted it. That traded at 21 and 21
Short everything.
2 months later. So
Those of you who don't know Doug,
So-
whereas a lot of us look for the silver lining and everything, he's looking for the dark cloud, and he's very good at that. by
So
the way.
they made a bunch of lousy investments, and the stocks likely would have traded much lower if it weren't for that. That much I agree, and I do agree that they have a long-term horizon until they don't, like Prince Aloid with Citigroup, who was responsible for kicking out Chuck Prince ultimately. So the investment mosaic is a very complicated one. It doesn't encompass just the credit risks that Brian discusses, or the ascent of new buyers of an asset class in the case of housing, day traders and homes, in the case of equities in the last year, sovereign wealth funds. And it's not necessarily influenced solely on just on the deaccumulation of debt or the deaccumulation of stocks, which was in Brian's charts. It's a very complicated, nonlinear equation that we have to deal with every day. And to me, it's very, I'll repeat what happened today. Just another, what is this, Wednesday? Another Wednesday in January, where the combined equity capitalization of all publicly traded companies in the United States moved by over 4%. Think about that. It's a frightening development. And it's really unfortunate that, and it has nothing to do with political affiliation, that we have leadership, fiscal leadership, monetary and executive branch leadership, which is really proven to be incompetent, proven to be timid and hesitant. I disagree with what you said about Bernanke, because I think that the strategy of reducing interest rates by 125 basis points, which again is an astonishing figure. That means we've reduced short-term interest rates by over 25% in 8 trading days in an economy that's supposedly, according to the prior speaker, fine, ex-housing. What Bernanke is doing is basically he's going to keep upward pressure, and this is why the markets faded today, and this is why the bonds faded, the rally in bonds faded. He's going to keep upward pressure on inflation rates. He's going to limit the degree of decline in long-term interest rates, which means the incipient refinancing mortgage boom, which really started a month or two ago, there will be an obstacle to that. So it's, again, a very complicated investment mosaic. None of us have the answer, but it's sort of scary when you see what's going on, both from a policy standpoint and from the standpoint of, as I said in the beginning, financial write-downs. This fraud is by this evil Knievel guy in Seton, Swiss, is really remarkable. That a bank of such consequence, we're not talking about, the Summit National Bank with $11 million of equity capital in New Jersey. We're talking about one of the 4 largest banks in Europe that didn't know this guy had $11 billion of positions on and lost $7 billion. And apparently he was only out $2.1 billion, and the unwind cost another $5 billion by the idiots who caused a panic last Tuesday and Wednesday. I mean, isn't this scary to people? Does that engender confidence?
The Fed doesn't have a choice because of the debt level of the society that we're in. They don't have a choice to let it ride. You've got to bring rates down enough.
I have always argued, Tom, you will attest to this, that the cost of keeping us out of recession exceeds the cost of a recession in the long run. Because your 2 boys that were in the audience, and you talk about all the time so fondly with me on the ride from New York City to here, are screwed because they're going to pay.
It's okay, I'll be dead.
99 years.
And actually, what's interesting and how it really works in the real world, we have our thoughts, but at about, what time was it when I leaned over and I go, isn't that some kind of setup? We had the same trade on today, which is kind of.
Can I throw my 2 cents in?
And I'm happy today. I had a great trade.
Can I throw my 2 cents in on the sovereign wealth funds? I think it's great that the sovereign wealth funds are putting money into our financial system, but they're putting money in on the equity side of the balance sheet, and the equity, putting new equity in is great, but all this stuff is a function of the credit markets. They're not buying credit; they're buying the equity side.
Aha!
And
very good point, Brian.
They're putting their money on the equity side. It hasn't stopped the credit markets from falling apart and being a complete disaster this year. It's true the Fed has lowered rates now by 125 basis points in 2 weeks, but junk bond spreads have widened out by 130 basis points to start this year off in the first 3 weeks of the year. So the Fed is only getting caught up to what's happened to the junk market. Today, the Fed got a little bit ahead of what they need to do, but there's a number of necessary conditions for us to continue to improve. They have to stay ahead of expectations, and they have to stop this deleveraging. that we just talked about, this flight to quality. We just found out this afternoon that in the week following the 75 basis point cut, Treasury money market funds took in another $18 billion. So even though they became more expensive, even though the price of safety became more expensive, people still flooded another $18 billion into the super safest investment you can find. That has to end before we can begin to improve. Will today's move stop that? It may. It has a chance of doing it. But if it doesn't, if we see another, 20, 30, 40, $50 billion come into Treasury money market funds in the next month, this is going to get worse, and it's going to spiral down no matter what the sovereign wealth funds do. It's at the
you're a
credit level.
deposit. Think about this. You're a wealthy guy. You're a George Soros, and you've got $1.5 billion parked at Seton Swiss because you made so much money in your offshore fund, you never repatriated any of the money, and the tax laws is such that until you repatriate from a hedge fund, if you have an offshore entity, you don't have to pay taxes. This could take Seton Swiss down. It's remarkable. UBS. Who's the group in the Mideast that just took the position in UBS last week? And apparently they're 15% of the company. This is also has huge political implications, whether you're Democrat or Republican. If the Democratic tsunami continues, Democrats are notoriously, the politics of trade protectionism will intensify. And even some of the Republicans now, you're starting to see a reaction to these sovereign wealth funds. And you no doubt in the next couple of months there will be bipartisan legislation which limits to a percentage of outstanding float, outstanding shares of these. I've already heard it from Barney Frank, of these sovereign wealth funds. So these things can be as spectacular as the numbers look. I think there's how many $1 trillion available? Multi-trillion dollars. It also could be a case of sic transit gloria. And I also wanted to say to the O'Briens, thanks for having us, and it's a nice thing you do.
Greg and I were actually talking about it ahead of time when we were talking about the UBS write-down. That, again, reinforces my view of how at risk the international markets are. They bought our stuff. So far, it's just the U.S. generally that's really had this problem disclosed. Now we have UBS and other ones. What do you think, Greg?
No, here, I'll relay a story. So last year I was in Europe talking about the markets, the credit markets, and subprime. And the response I got in Europe and Asia was, who cares? It's a U.S. issue. And the joke is, and we kind of knew because we know where the street placed all this stuff, is that the product was actually placed largely in Europe and Asia. And they're still kind of coming to grips with that. So, you look at UBS, for example, and you look at where Merrill marked their losses and Citi, they're way too high. They're about 20 points too high. And that suggests that there's a lot more losses on the horizon. And, Asia, hasn't even begun to even recognize the losses that they have. So
now the firm that Greg works for, the firm that Greg works for, I gave the example of Merrill Lynch, Morgan Stanley. I believe my numbers are probably off by a couple billion, but Everett Dirksen said $1 billion here, $1 billion there. Soon it's real money. I think you guys started with $19 billion or $20 billion of shareholders' equity, right? Into January 2007. And what's the write down so far? About 8?
Yeah.
So in other words, 45% of the shareholders' net worth of Morgan Stanley, one of the most venerable institutions in the world, disappeared into money heaven this year.
I know that painfully.
I want to.
Can I pick up on that thought for just 1 second? Because what we've been talking about is really what has happened. And I like to look ahead because that's where I make my money.
Well, that's what I was going to say. What do we need to do to get us out of this mess?
Well,
define mess you've got me into.
I said it's very clear what we need to do to get out of the mess. It's 3 things. The Fed has to get ahead of expectations. They've done that. Now they have to stay ahead of expectations. This flight to quality has to stop. The reason we have to do all these things is because all these write-offs we're talking about, that's just getting us caught up through the 4th quarter. No one's talking about what a disaster we've had this year in credit. You know, I said junk has risen 130 basis points this year, and this year is only 4 weeks old. Well, now that you have to mark your assets to market, if the junk market stays like this, we're going to have a whole nother new round of write-downs, and that's going to last into '09.
You know, Brian, the problem is this. Household net worth is essentially a function of two items: equities and home, the stocks and your house. So we have an inventory of unsold homes about 12 months. You know, it's a disaster. It's getting worse. You know, we probably have at best stabilization in the second half of 2009, some slight recovery in 2010. But, you know, the nature of housing down cycles is 4 to 5 years. So that means that the burden of financial net worths lies squarely on the shoulders of equities, and as we've all learned in January, that's a slippery slope. So then you have a consumer from 2000 to 2006 added $10 trillion of mortgage debt. Taken as a percentage of disposable income, mortgage debt went from 62% to 104%, and that doesn't include consumer and installment debt, which takes it up to 146%. The increase in mortgage debt in the last 6 years, percentage-wise, is larger than the increase in the last 55 years.
We're going to take some questions, but just one thing, Brian, when we were sitting in the trading room today and the Fed dropped rates by 50 basis points, and I asked you about the credit markets and in particular corporates, what was your response?
It was a love fest, but then at the end of the day, they started selling off the credit derivatives. And if they keep selling the credit derivatives and we keep seeing money go into Treasury money market funds, this is going to spiral into a disaster.
Thank you.
All
right. Go ahead.
We now entertain questions from the audience. Please step to the microphone in the center aisle if you have any questions.
Turn the lights up.
Testing.
Mic on.
I read your columns in TheStreet.com religiously. Remember, the first week in December, where you were covering some shorts and you said there was not going to be a recovery in the market. I took that to heart and went long. Now, comments, please.
You obviously don't read it religiously, because after the let me finish. Because after the rally, which I happened to have been premature on, because the market fell another 3 or 4%, if I recall, we had a spirited rally, and I said at that point that the rally was short-lived, and I remember being on Kudlow to memorialize it, and I said, and if you read it every day, I turned appreciably more negative. In fact, I remember the title of the column. The title of the column was called "Happy Days Are Not Here Again." But it's just my guess, anyway.
We're all guessing at this point, right?
Okay, I'd like to ask the participants, for the equity participants, what do they think of savings banks this year, loan institutions as investment, and home building stocks? And for the credit people, where do they see interest rates in the form of treasuries 10 and 30 years by the end of the year? Thank you.
Let's take that one first.
All right, I'll go first. What I wrote this year in my 2008 Outlook was that if you like 2007, you're going to love 2008. And when I say that to people, they go, oh, no. But it's true. It's all going to be a function of what happens to the credit markets. We know that we're going to have more attacks on the credit derivatives markets, and we know that they can get oversold relative to the underlying credit. What that means for treasuries is that it's going to be a volatile year. In fact, my theme this year is to buy volatility whenever it cheapens. So if this credit crisis continues, if it...
one of your fans.
Yeah, I know. One of my... if this deleveraging, which I thought was a great phrase, continues, we see this panic flight to quality happen, you're going to see it spiral down, and you're going to see more people selling corporates with corporate yields going up and Treasury yields coming down even more. If the Fed gets ahead of expectations and we stop this flood of money into Treasury money market funds, then this rally we've seen in Treasuries is going to spiral into reverse as stocks go higher and credit gets better. So it's really a function of, can we stop the panic flight to quality? If we can, Treasury yields are shooting higher. If we can't, they're going to spiral lower.
Thing. Where was that guy that asked the question over there? I don't believe there are many publicly held savings and loans. Oh, that's different. No. That's a different story. On the home builders, that's a great question, because you're supposed to buy at the sound of cannons and sell at the sound of trumpets. And when things look almost irrevocably terrible, as they do for the home builders, it's probably time to start looking. Interesting, a couple of those companies have had quite consequential insider buying, like Hovnanian. Our Hovnanian bought 400,000 shares last week. Stock went from 5.5 to 9 overnight, so there's plenty of opportunity. You know, if you look at the, I don't know if you guys look at the something interesting is happening in the inventory of unsold homes. For the first time, the inventory of homes is declining in absolute terms, although the months of inventory is rising. And the reason for that is the relationship is the inventory of homes divided by the monthly amount of homes that are sold, so that the denominator is so weak, so, you know, the current level of home sales is so low that it's kind of artificially creating a ratio which looks like it's expanding just at the time you're starting to see inventories coming off in absolute terms, not months of inventory. So you're probably there in the next 6 months, which is unusual for me to say something positive about anything.
Especially the home builders. Yes.
When non-financial types ask me how it can be that a small drop somewhere in the world can cause the whole world to seemingly collapse, I start to talk about forced selling, and we get into the concept of leverage, and I find myself saying that, as far as I can tell, people are allowed to borrow 10 times their capital to buy things, and maybe more. So my question is that true? I mean, and if it happens once in a while, okay, but I mean, can almost everybody do that?
No, just a second. But let me answer this. When I worked at Merrill Lynch, I was a provider of leverage to hedge funds. Long-term capital was a counterparty of mine until I kicked them out of Merrill Lynch, at least the equity division. Leverage is wonderful when it's working your way, okay? And it is probably the best drug in the world. However, when it works against you, okay, it is the absolute worst thing that you can imagine. It's death by 1,000 cuts. And I think leverage is important because let's look at where things went wrong and where things are wrong now. It's the leverage that was in the system, be it in terms of home building, or speculators who bought homes, or CDOs, or this entire mortgage market. But what I find absolutely fascinating, and no one's mentioned it here, if you look at corporate balance sheets, ex-financials, and you look at their balance sheets over the course of the last few years, corporate America is in the best shape ever in terms of their balance sheets. They have removed leverage from their balance sheets. They've increased equity. They've bought back stocks. And so, with the exception of the financial companies, corporate America now realizes, you know what, deleveraging is not such a bad thing. And they'll probably make out better if indeed we do go into a recession or a pullback. It's those that are too leveraged right now, they get forced to sell, all right, that are ones that are going to spiral out of control.
But my question was, can financial companies actually borrow 10 times their capital routinely?
No. Not on the balance sheet. Off the balance sheet, who knows what's there?
Not financial companies, but you think back to that first chart I showed showing the amount of derivatives relative to the underlying amount of corporate bonds. 50 trillion notional derivatives with only 2.5 trillion underlying. So in terms of the systemic leverage,
these guys,
it's off the chart.
These guys are not right in their answers. Financial companies, the major banks, the major brokerage firms routinely borrow 10 times on equity. My recollection is, well, Tier 1 capital ratio requirement for a money center bank is around 5.5%, so that's 20 times leverage. The average brokerage company, and that's a state of flux, obviously, in today's credit market, borrows between 16 and 29 times their net worth.
Well, I mean, isn't that inherently unstable?
Yes. Yeah. It's unstable good and it's unstable bad.
I don't know an unstable good.
Well, leverage, as Scott said, leverage is leverage.
That's always been the case.
Leverage cuts both ways.
The systemic problem today is not the brokerage companies per se or the money center banks, because their for Citibank to have a serious erosion in capital, their Tier 1 capital goes from 6.4% to 5.6%, and that's a big deal, and they're cutting the dividend. The problem lies as I described before, in the shadow banking universe of hedge funds and all these conduits and structured investment vehicles. And the first one the common person found out about was long-term capital in 1998. But today, there's not just one long-term capital. There's so many, no one knows.
In light of the uncertainties you have in the market right now, where do you see the financial markets on December 31st, 2008, and in which sectors would you be putting your money?
I see it flat to maybe down over the next, over the very near term, but for the course of the year.
From here or from the beginning of the year? From here.
From here. I think we're going to go through a difficult bottoming process, but ultimately I think we're going to be over 1650 plus. The stimulus that's going in the system is very strong. Infotech is our #1 sector. Healthcare is our #2 sector, and we'll see.
And that's by the end of the year.
It's by the end of the year.
And so you like infotech?
See, you know what? Yeah, I think you have to realize too is this is such a media thing. The end of year target. People shouldn't invest based on a calendar day. They should invest based on where things are at that time. So at 1560, whatever the market got to in July and October, are you guns ablaze? And if you got a 1650 target, you got 90 points of upside, not like you were at 1250. So I think you have to take it from where you are versus these calendar-oriented predictions. My disclaimer, thanks.
How about you, Brian? What do you think?
Well, I kind of said it before. We're on the edge of history. It's either a 98, 99 type of history or an 01, 02 history. I can't tell you. So what I've told my clients is that you want to load up on volatility whenever it cheapens, because I viewed last year as a transition away from the low volatility environment to the high volatility environment. If those things come into play that I said come into play, we're rocketing higher. And if they don't, if people keep putting money into Treasury market money market funds, we're spiraling lower.
Well, what's the 98 scenario? What is
Well,
that?
the Fed got ahead of expectations, the panic flight to quality stopped, and then people started buying credit. Same thing needs to happen this time.
Up 28%.
So then, if we have that situation, then the equity markets would respond positively.
Yeah, then we'll go over 1650 this year.
And if we have the 01?
I've written that the way the credit market opened up this year, it was as if the S&P opened up at 1175. So let's say somewhere south of 1175, because this will spiral down if those things don't happen. Sorry, I can't be any cheerier, but my job is to reflect reality.
That's fine.
But I think it's going to be choppy. It's going to definitely trade down near term, but I see it kind of flattish to slightly up by year end. I think what's going to lead the charge is the financial space, as the write-downs and the losses are finally going to get behind you, and you're going to start to make money there.
I can tell you something.
this has been one year that I've been wrong after being so right for the last 5 to 6 years. And so even I have to, at this point in time, kind of go back a lot to the drawing board. I do think that the equity markets will recover. I think that eventually we will break the back of a lot of these credit market issues that Brian has described. I think nothing that we didn't talk about here was, and I think it's something that's going to play big into what goes on, and that's what happens in terms of the European Central Bank, who till now have been rather intransigent because they really think that their biggest problem is inflation, but they don't really see growth problems. They don't probably see a spillover. So I think that we need to get the world back in sync, and I think what's been happening recently is that the world has becoming out of sync. I think over long periods of time, as I put up that chart before, I think the equity markets are where you want to invest. It's going to be rough. I don't know if I can say I'm going to pick up a top or a bottom. We could have another 10% downside. There could be blood coming out of people's eyeballs. I'm not quite sure. I do think, and I agree with Greg, that I think financials will lead us because those are the ones that have been hit the most. I still want to stay in tech. I still like Apple. I like it even more that it's down. I think that definitely there are areas that I want to continue to avoid. I want to avoid the pharmaceutical area. I just see absolutely no upside there. But this year is going to be a roller coaster ride. There's no doubt about it. And it's going to be a year in which you're going to feel in the pit of your stomach a fair amount of bile. I think it's a year in which the individual investors, more so than ever before, are going to have to put more trust in some professionals out there. The last thing I'm going to say is, and we're all guilty, if you want to call us guilty, of being part of the financial media, because we're often interviewed and we appear in the financial media. Be very cautious as to what the financial media is blabbering constantly all day long. No one really spoke up here about recession, but if you listen to CNBC, it's the recession station. And so, don't try to get yourself worked up because of what you're hearing out there. Do your own homework. I'm very uncertain about this year, and because I'm not going to be able to pick what's going on, but I'm still going to do what I always do, and that's, just do my homework and look, because I'm primarily a long manager, continue to invest in stocks with solid balance sheets and growth opportunities.
Gentlemen, you are...
Let me just answer. It's a dumb question. And it's a dumb question because no one knows in the next 11 months what's going to happen. It's just a guess. That's the answer. If you look at any if you look at the smartest strategists, no, you asked the question. You said, where's the market going to be at the end of the year? Okay, you didn't ask that question. Let me just address it the way I think the question should have been asked, and I'll give you my answer. And again, it's a mosaic which includes psychological, fundamental, technical, voodoo, everything together. The average equity investor is not an investor if he's asking the question, what's going to happen in 11 months? The average equity investor should look at the next 3 to 5 years. And we all know what the returns are. Scott said what the returns were over the long term, roughly between 8 and 9%, depending upon your time frame, the last century. It seems to me that what everyone is talking about here is that many of the tailwinds, the monetary, the fiscal, the psychological tailwinds, political tailwinds of the last 5 or 6 years are going to be reversed, so that we face a period of inconsistent, lumpy, and uneven economic growth, far different than the past, which investment managers and corporate managers will find it hard to navigate in. So in all likelihood, we face a period of substandard returns, which means something less than the 8 or 9% growth rate. And the answer to where you put your money is also a silly question, or a dumb question, because everyone has different risk parameters. You may be an emerging entrepreneur who has very limited money, that your business is, everything's on the line in your business. You can make it or you're not going to make it. You'll have very little cash flow to invest. You have different objectives. The couple behind you is a couple of years older than you. And probably he looks like an ex-football player, actually. But you're probably retired, and he has far different financial objectives than you have. So it really depends upon your risk profile. So you go to someone like Scott, and he assesses your risk profile and what your objectives are.
Before we get to Tony, Greg has to catch an airplane, so I want to thank Greg for appearing with us this year, and we welcome you back next year. Thank you.
Gentlemen, you have all noted that the U.S. is clearly weak, and we've been hearing for a long time that the U.S. economy is weak. What about the global economy? We keep hearing that it's roaring, that it's doing very well, and given that these two situations are going on, we have heard the word decoupling, suggesting that...
Decoupling, you know what decoupling is?
My question is, will there be a decoupling or not? And to what degree?
It's totally BS. Decoupling is another one of those new paradigms, the last of which we had in the housing boom, which, we were going to have an uninterrupted housing boom, subject to very limited cyclicality, which was preceded by the internet and technology boom in the 1999 and 2000. Again, we were going to have a long boom in these stocks and a sustained period of economic growth. It's another nonsensical term. And if you
think about the global growth right now. You've got a GDP in 3/4 of the world that's almost negative. Who's the end market? I mean, it's Europe, it's the U.S., it's Japan. Where's the consumption coming from that's going to fuel the growth to continue overseas? That's why I've been so wrong in materials and energy, because yes, that secular story is true. There is better global growth than there has been historically, and it's much more global economy. But I like to think about it again using an analogy. I can sit in front of a client, and I can have my laptop open. Doug is in the car. He's got a high-speed wireless internet access on his high-speed laptop, right? He's cooking. He's got the market open. He's doing his thing, his instant message going. It's actually driving me nuts. But, he's going good. That secular story in telecommunications and technology absolutely was correct. There's a difference in the stock prices, though.
There is one consequence to the economic. There's one consequence of the economic imbalances. A weak, U.S. not being the power anymore, and the BRIC countries being the source of incremental, marginal GDP growth, is that it will sustain a period of relatively high inflation in an economic downturn. So what that portends, and abetted by what Bernanke did today and last Tuesday, is kind of incipient stagflation, something that only graybeards in the investment business remember from 25 years ago. And stagflation is the cruelest tax of all on the consumer.
Since you're saying there will be no decoupling and the rest of the world will suffer.
There already isn't. That statistically, there already isn't. And the problem, I was in Germany presenting to institutional accounts, and these portfolio managers had not been shown the chart of how German growth was almost zero.
Not only are we not decoupling, believe it or not, we're increasing the amount of integration. Actually, that is over the long term going to benefit the global economies because we're going to become more diversified instead of having separate economies. What I had mentioned before was the problem we're having in the short run is the central banks aren't talking to each other, something that Greenspan was very good at. And unfortunately now we've got a whole bunch of new leaders there and they're not speaking to each other. Next question.
Sure.
It's for the whole panel. If you were to invest in any one foreign market, what would you recommend? What instrument would it be, and why?
You're looking for major growth. You're looking for kind of a stable, growing foreign market.
I'd look at mainly for growth.
Like quick term growth.
Yeah.
You know, there's no doubt that over the long term, I think China is going to be a market that's going to give you long-term growth. But I'm going to tell you a market that no one talks about that, frankly, has had some slow but steady growth and has made me a lot of money over the last several years. That's Israel. I knew that. Yeah. There you go.
How did I know that?
All right. Because the fact of the matter is that they are a hotbed of technology and biotechnology. They don't have mortgage problems there in Israel. They got other problems. But certainly in terms of the stock market, that has been a very stable area. But if you really want kind of this leveraged type of momentum, then you want to stay with what people call the BRIC nations.
I was wondering, do you guys have any forecasts for the commercial real estate market in the next 12 months?
Dead. Niedermeyer, dead.
Yeah.
Commercial buildings, dead. Just started. The decline just started.
Yeah.
It is remarkable to me. My neighbor in Long Island, where I live in East Hampton, is a guy who's chairman of a company called Renato, who actually started in Jersey. It is remarkable what he tells me about the credit markets, the commercial building credit, access to availability to credit is totally shut off.
I speak to people in the commercial mortgage business, and I speak to attorneys who do a lot of the major commercial legal work, and they've all said there are deals to be done. There's just no liquidity for the deals. People want to buy real estate, and what's happened, unfortunately, because of this drying up liquidity, there's been a lot of short-term lending that's gone on, and a lot of them are finding that they can't roll it over. So it's going to cause a problem.
You're going to probably have a major bankruptcy in the next week. Maclo, fellow bought a package of buildings, including the General Motors building, probably. It would be a very high-profile disaster, which is going to scare lenders further.
Interest rates are going up if you look at corporates.
Yeah, interest rates, it's irrelevant to the cost of money. It's the availability of money.
I have a couple of questions, but I'm just going to note it down. I'm not going to ask you about Under Armour, but maybe over cocktails we can talk about Under Armour. And I'm not going to ask you about who do you think is best equipped to handle the complexities of the markets you talk about in the White House. Not the smarts, but the ability to manage. Not going to ask you about that. I am going to ask you if you would consider perhaps offering a 3 or 4 day seminar to our students at your convenience for credit. So we'll talk more about that, perhaps over cocktails as well. But I also would like to know, as an educator and trying to prepare our students for the very best, name me a skill or a competency that is a gotta have in their undergraduate preparation here.
Common sense. That's the best. That was hammered into me by my mentors. You can be as complex and as hyper-aggressive as you want, but you need the grounding in common sense. That's been the thing that's kept me grounded throughout my whole career.
Common sense comes from probably failures.
Oh yes.
Work.
Oh yes.
So you're talking about internships and sampling.
And that's one of the great things about this program is that when I got out of college, I didn't even know what the Dow Jones Industrial Average was. And I learned this business because I got into a firm with some great mentors that let me have real-world experience and let me make mistakes. They'd stop me before I made too big of a mistake, unlike the SoGen thing, but they would let me get the experience. And I come here and I see these kids, managing actual live money, and they've got that experience and common sense. And I've always said I always love coming here because this is one of the most fun nights in my calendar. And so programs like this help instill that common sense.
I would say, I was a political science major at Lemoyne College, which is a Jesuit institution about the size of Seton Hall in upstate New York. I don't have any aftermarket degrees. I don't have a CFA. I don't have all the stuff that these guys have. These guys are smart. But I'm up here with them anyway. And I think what got me, the best way I can convey what I think is important is work ethic, honesty and integrity, and communication ability. That's what got me where I was. When I joined Prudential-based Securities, Larry Wachtel, who just recently passed away, he answered, I swear to God, he answered 1,000 phone calls a day on what was happening with a different stock or whatever. I was the only guy that answered his phone. So when it came time for CNBC, or at the time it was FNN.
Fox.
When it was FNN. No, back in
Right.
FNN days. When he hurt his knee and needed an operation, who'd you think he told to give a shot? Me. You know, it was because I worked hard for him. I was honest with him. And, you know, I did my best. I tell my kids 3 things, and I tell adults 3 things. Do the best, do your best, tell the truth, and believe in yourself. And that is how you get successful. Thanks.
I would say that that one of my mentors who I had dinner with last night is worth a little over $1.5 billion. His name is Leon Cooperman. He runs a hedge fund. I was his partner in the 90s called Omega Advisors.
And he is a big giver to Seton University.
Oh, and he told me he endowed he gave one, because I told him I was doing this last night. He said I sent you the email. He gave 1.75, I know what he did. He gave $1.75 million to Seton Hall for a Judaic.
The Sister Rose Tieran.
Thank you, Judaic Christian Studies. I know the Judaic part, I didn't know how to be honest with you. Anyway, so he told me something that was really very practical. And Bob, when he was a partner at Goldman Sachs, he ran the investment part, research and asset management before he founded Omega in the early 1990s. And he said Bob Rubin taught him whenever he makes a decision now, no matter how important, do a balance sheet and list the positives to that decision and list the negatives, the liabilities to that decision, and evaluate it honestly. It's a good exercise.
I'm going to ask all of our panelists for one closing remark. Brian?
I just want to reemphasize, I think if you liked 07, you're going to love 08. At this panel last year, I was a raging bull because things were so cheap. And we put in a new high, and then I got bearish, and I got bullish, and I got bearish, and I got bullish, and I got bearish again, because the credit markets were going all over the place. It's going to be like that going forward for probably the next 2 or 3 years, I think. And that's where the common sense and the discipline comes in, because one thing I've learned, another thing I've learned in this business is that there are a million ways to skin a cat. I know guys who trade technicals. I know guys who trade fundamentals. I know people who invest based on astrology. But yes, believe it or not, and the ones that I found that are successful have the common sense, and they also have the discipline. They know what they know, and they know what they don't know. Common sense and discipline, that wasn't the mark of what happened in SoGen. That's the opposite, and that's how you get the SoGens. No common sense and no discipline.
I went to business school in Philadelphia, and I remember being at Smoky Joe's one night.
Oh, I was there many nights.
Around 3 in the morning. Around 3 in the morning, drinking. It was a local beer place in Ward, and I was drinking beer with my thesis advisor, who was also pretty drunk. And we were talking about investments, and I asked him, what is the single most important dictum? And I remember this more than any class, and I had some great teachers. And it's so simple to say, and it's so hard to perform. And goes like this: stop your losses and let your profits run.
I guess my final parting point would be that if you guys are sitting in this audience and you're looking for a job next year, you better get all our cards. Right? You got to be aggressive. This is a workplace where there's a tremendous amount of competition, and as part of management at my firm, we would hire somebody that shows what I said versus somebody that comes to me with some ridiculous prediction, because I know that's wrong, because mine are wrong. Right? So, again, those 3 things that I tell my kids, but, convey it and be aggressive. Be aggressive in your abilities and confident even if you don't feel it, because that's how you get a job. And you got to network. My whole thing is networking is so big to my career. I do it to this day. I was at dinner with a bunch of Wall Street guys last night. it's all these little things that add up to a successful career. And by successful career, I don't mean getting paid a lot of money. I mean doing something you really enjoy. You wouldn't be sitting here for the last bunch of hours if you didn't enjoy this topic. Why is Tiger Woods the best golfer by far in history? It's statistically already almost.
Because he works the hard
He's
side.
got a natural ability.
He
You
works
guys
the
have a
hardest side.
natural interest in finance, and he works the hardest. I guarantee you, nobody hits more putts or golf balls than Tiger Woods.
Maybe VJ Singh.
I don't know. It's pretty. He's okay. He's second. He's a good second too. Anyway, thanks.
Not bad being second to Tiger Woods. Look, I just want to wrap up first of all by thanking everyone who was involved in today's colloquium, from our presenters, Chip Dickson, to our panelists, Ryan Reynolds, Greg Peters, Doug Kass, and Tony Dwyer, to our wonderful group of students from the investment club, who really did a fantastic job. To everyone who's helped me behind the scenes in this process, Pam Dungy, and the whole team of Seton Hall staff. Putting this event really takes, I would say, a good 9 months, and you don't really realize it until you have to do it yourself. I like to say it's almost like putting together a bar mitzvah or a wedding. And that's how much work really goes into this. And these guys are great for taking out time of, taking out from their precious schedules in these crazy markets. And the last thing I want to say is, I can't say enough for thanking the people who have helped us support our trading room. Jim O'Brien, the entire board of the trading room, Dean Karen Boroff, and Tony Levisic, because the work that we've done here is really paying off huge dividends. I've been at this university now for 6 years, the last 3 years full-time, and I can tell you that in the course of the last 2 or 3 years, our students are starting to get job offers from top-tier firms in revenue-generating roles. So now we're getting students into places like Bank of America, Merrill Lynch, Morgan Stanley, Bear Stearns, and years ago, as much as maybe 3 years ago.
They're not going to be around.
Well, that's true. But years ago, Doug, those firms wouldn't want to interview anybody from the Stillman School of Business, and if they did, it would only be for back office jobs. And now these kids are getting jobs on the front line, at currency trading desks, fixed income trading desks, at hedge funds. And I think that really is a testament to what everyone who's been involved in this program.
And by the way, to the dean, I would be pleased to lecture whenever you wanted me. I teach at Yale, actually, right now.
Myself as well.
So, really, at this point, I'd like to adjourn until next year.
Let's
And, thank you.